Hey guys, it's Matt here, doing another skeptic video. This time, JDub Trades is the victim. Uh, Although I say that lightheartedly. Again, when I do these, I'm not here to call anybody out or call out any gurus or anything like that. It's more just let's look at what's out there in the YouTube world as far as supposed strategies that work, and then take a skeptical look at them and see what we can actually learn from a video, and then what also we have to be a little wary of and maybe take with a grain of salt. So let's jump in here, and yeah, we'll get going with Mr. JDub here.
In this video, I'm going to show you guys a simple scalping strategy that you can use every day to make consistent profits in the market. This strategy presents itself every single day within the first few hours of market opens. It requires no buys, super beginner friendly to use, and sets up very often.
Did he say it requires no buys? I don't know. I don't know what he means by that. Maybe I misheard that. But I like it so far. I mean, first couple hours of the trading day, that's great. It's a good solution for people who maybe have a full-time job or just don't want to sit in front of the screens all day for whatever reason. And he said it's simple, so it's good if it turns out to be legit.
So with that being said, let's get straight into the video. So as I talked about in the previous slide, this strategy is very simple, super beginner friendly.
Oh, he said no bias. That makes sense. Okay, so you can go long or short. Cool.
To use, and it happens a lot of the time right off the market open. So what this strategy is good for, it requires no bias. So you don't have to guess where the market's going to head towards that day, right? You don't have to guess if the market is going to push towards the upside, right? Push towards the downside. I know a lot of you guys have trouble trying to find the bias for the day, but this strategy,
that's actually a really important thing he's not saying it like I would, but that doesn't mean he's wrong. You don't know whether the market's going up or down today or tomorrow or any other day. No one does. We can take guesses, but your trading strategy shouldn't rely on that. Even if you're, let's say, a long bias trader, you aren't going to know whether the market's going to go up or not before you get into a trade. You can start to see it go up, right? And then go, oh, here it goes. Maybe it will keep going. That's where risk management comes into play, guys, is like if you see a setup going, you assume that the market's going to go in your direction. You take the setup. Sometimes the market says, fuck you, and turns it right around and stops you out. And that's okay, because if you have good risk reward and you have good risk management, then you stop out and you take your stop and you just walk away. It's no big deal. You know that when a winner does happen, it's going to far outpace your losses, so everything's fine. But anyway, yeah, not needing a bias is a good idea. In fact, it's necessary, most likely, because you don't know.
Requires no bias coming into market open, so it makes it very easy and beginner friendly to use. Second is time. So you don't have to wait a few hours for this setup to form itself. It happens right off market open, and majority of the time, right, the trades will form within 9:30 to 11 a.m. And third off, right, it's very easy to use. It's so easy that even a beginner can use this strategy to make money, because it is so mechanical, cannot mistake how this trade forms. It is not discretionary whatsoever. You have a clear strategy and setup that you can execute very mechanically, and you have a clear stop and clear profit target.
Oh, I love what he just said there. And I was stopping it for a different reason. The fact that he was saying that it's not really discretionary and you have kind of clear criteria to get in and out, that's very important, especially for beginning traders, because the first thing you really need to do is train yourself to be able to follow a system and kind of get control over the emotion and psychology that comes into trading. And then maybe eventually discretion to some degree might actually improve your trading once you've got all that stuff managed. So that's really cool.
Every single time. So some of you guys might be asking, what is this strategy? And this strategy is simply the opening range break and retest. You guys might have heard the opening range break before, but I trade this a little bit differently.
Okay. Yeah, pretty common setup. It's not anything earth-shattering here, but I'd
I
like
like
to
to
see.
trade the opening range break is by simply waiting for that opening range break to happen and then looking for that retest and that extra confirmation to trade to either way. So I personally do not like trading breakouts. As you guys know, I like trading the break and retest, and this is the perfect way how you can incorporate the opening range break into your strategy. So what are the simple steps and what does the opening range break look like? So as you can see in example number 1, this is what's called your opening range. So the first thing that you're going to do,
I'm going to speed this up just a bit, guys.
is mark out your opening range high and your opening range low. This can either be on the 1 minute, this can either be on the 5 minute, it could be on the 15 minute, depending on what time frame you want to choose, right? Me personally, I like the 1 minute and 5 minute, so I'm going to be marking out the high of the first either 1 minute or 5 minute candle. In this case, right, this was the high of the 5 minute and low of the 5 minute. Second, what you want to do is wait for strong displacement or a break to either side. As you can see in this example, at number 2, right, we drew out the high and low of the first 5 minute candle. You can see, right, price was trying to break above this 5 minute candle, but it didn't have strong displacement. You can see these upper wicks forming. This is signaling to me that the buyers are not stepping in, right? Sellers are trying to push it down. And you can see this next subsequent candle was very bearish, right? We had the
I would love it. He might do this, but I would need to define what is a substantial push above that. What does that mean? Does that mean the candle has to? Uh, we have to have a candle that's all of the the high, open, low, close is all above that pivot line there, the high, or does that mean it has to be the close has to be a certain percentage away from that? I would need that quantified, especially since he said this was um, a quantifiable setup and didn't need discretion. It sounds like there's some discretion in there already. Like what is a substantial break or push above that level?
bearish candle closure underneath this level, right? We had displacement on this break as well. And now we can look for the break and retest of the opening range low. So you can see here, right, we end up breaking below, closing underneath. And now you can see on number 3, right now what we're going to be looking for is that retest. So you can see right here, price came back, retested its opening candle range low. That's where we're going to look to buy with stops above the opening range high. And then what your targets are going to be is a 2-to-1. So this strategy is very mechanical. You want to mark out the
I like the 2-to-1 strategy. That's pretty solid. It gives you a decent risk reward. It means your win rate can be 50% and you're still making money, right? Probably even a little less than that, right? 40% would probably work. Yeah, I like 2-to-1 risk reward is juicy.
high and low of the first opening range, and then you want to wait for a break with strong displacement and a retest of either the opening range break high or opening range break low with stops above and below either of those levels and target a 2-to-1. So with this being said, now we're going to be looking at examples I have, and we're going to be back testing a stock for 1 week to see how the strategy performs.
Okay, when I picked this video, and I don't think I went over this at the beginning, but the title is "You Can Make $500 a Day," which again, guys, this is a YouTube title thing, but like it doesn't fucking mean anything. $500 a day with what size account? Like what? That doesn't mean anything. If you're making $500 a day on a $50 million account, is that really that impressive? If you're making $500 a day on a $10,000 account, wow, that's pretty cool. I mean, that's pretty low. Most people can probably scrape together $10,000 to get started trading if they really want to, if they save up for a long time, and they can make $500 a day. That's probably good, right? But it just doesn't mean anything. I hate those. But anyway, that's why I picked this video when I saw it pop through my feed, and then also it said backtested results, which I was like, ooh, that's legit. Like backtesting is awesome. Which, by the way, guys, backtesting for a week is pointless. It's not nearly enough data. You want a backtest of multiple years, hopefully, and then you can also look at how did this perform in different scenarios, like in different market environments. Like, okay, we were in a roaring bull market for the 6 months. How did it perform there? We were in a choppy market for 6 months. How did it perform there? And that requires much more than a week's worth of backtesting. And for that, you probably need something. I mean, you can do those by hand if you have the patience and dedication, but probably something like SpikeEat or if you're good with coding, you can just use Python and grab data from Polygon, and do your own back tests, which, yeah, I mean, however you can get it done, do it. But back testing for a week is it's kind of silly. But well, let's see where he goes with it.
So before I hop into the charts real quick, I just want to draw a simple explanation of exactly what the opening range looks like. So let's draw a candle, for example, right here. We have an upper wick and we have a lower wick right here. So this is basically going to be your opening range high and your opening range low. Essentially, what we're going to be looking for is a break with strong displacement, a retest of this area. That's where we're going to be looking to buy with your stops below this opening range low candle and your targets being a 2 to 1 above, right? So this is what it's going to look like towards the upside. And the same thing for the downside. What we want to do is mark out our opening range high, opening range low. We want to wait for a break with strong displacement below our opening range low candle, come back up, retest this level. That's where we're going to look to enter with stops a break above the opening range high and our targets being that 2 to 1 towards the downside. So this is exactly what the opening range break and retest looks like with a line chart illustration. It is very simple, very mechanical, right? You don't want to look for a bias. Obviously, if you have more confluences, you can add that into your strategy as well, but you want to keep this as simple as possible. You do not need a bias to effectively execute this strategy. So with this being said, let's start backtesting for a week. As you can see, we're on SPY here, and we're going to be looking at the opening range break.
I love that he's using SPY because, I mean, it's got plenty of liquidity, right? You know, I mean, even if you're a whale, you can definitely get your orders filled on SPY, right? Most likely. So, yeah, that's good. That's good. It's easy to backtest too because it's like it's just easily available to get data on SPY. You know, because it's such a big vehicle. So, you know, it's not like sometimes when you try to get data on some of the like the small cap stocks, and it's like, you know, they were delisted for a while or something, or you know they were in the OTC markets for a year, or they changed their names and all kinds of other stupid shit that happens, or all the splits that happen, which makes data a mess. But yeah, anyway, pretty cool that we're using SPY here. I like that.
On the 5-minute time frame, and we're going to be backtesting this for 1 whole week. So the first thing that we're going to be doing is waiting for that first minute candle to develop. So after that first minute candle develops, you want to mark out your opening range high and your opening range low. Right, so now what we're going to be doing is waiting for a break with strong displacement and looking for a retest of that level for a move to either the upside or the downside. So
still waiting for a specific criteria for strong displacement. He did mention something about it closing below, but there wasn't really enough information for me.
we fast forwarded here. So price finally has displacement. We'll see if it comes back and retest. And as you can see, right, this would have been a day where the opening range break and retest, there would have been a no trade based off of this setup. You can see we had the displacement right here. We were looking for that opening range break and retest. We never quite got it, right? Price ended up spilling towards the downside. So in this case, right, we're going to be looking for it the next day for the opening range break and retest. Okay, so now we're on the next day that we have for the opening range break and retest, and we're going to do the exact same thing. So the first 5-minute candle is formed. We're going to mark out the low of the first 5 minute, the high of the first 5 minute, and we're going to wait for a break of either side with strong displacement. So you can see the second 5-minute candle, no real strong displacement. The third candle, we do have a little bit of displacement towards the downside, but you can see we ended up quickly getting bought back up. So right, there's no opening range break towards the downside, and we keep playing the tape here. You can finally see right there.
Okay, so he's not considering that enough of a displacement there. So I'm guessing he means a candle that is body and wick below, with space in between below that pivot there, the opening range low.
Right, we have that strong displacement, we have that continuation towards the upside. So you can see right here, price is pulling back into our opening range candle. That's where we're going to be looking to buy with the stop just to break below the opening range low of the first 5 minutes. And of course, we're going to be looking to target at least a 2 to 1 risk to reward ratio. So as we play the tape here, that would have netted us a very nice 2 to 1 risk to reward ratio on SPY for our first win of the week. Now we're on our third day. What we're going to be doing is marking out our high and our low, right? So we mark out our high and we mark out our low of the opening range on the first 5 minutes. And we're going to wait for a break with strong displacement to either the upside or the downside. As you can see in this example, we have a strong displacement towards the downside. You can see this leg very clearly, right? Strong displacement. Now what we're going to be doing is looking for a retest of the opening candle range low with stops above, and then you want to target at least a 2 to 1 risk to reward ratio. So let's wait for that retest. You can see right there, price ended up tapping into our retest level. Now we're going to be looking for a short off this opening range of the first 5 minutes with stops just to break above, and we're going to look to target at least a 2 to 1 risk to reward ratio. So we can target a 2 to 1 in this case, or we can target low of day as well. So we can target.
Okay, guys. So one thing that I like that he's doing here is it is very mechanical. It's like, okay, we got this, we got the push below our level. You could basically set a stop limit order right at the whatever the that opening range low is to get filled, whatever position size, and then you know exactly where your stop's going to go, and he's using that 2-to-1 target, so you know exactly where your target's going to go. You could literally just set up a what's the order type, like where you got a limit order that gets you into the trade that automatically triggers your stops. You could set that and walk away, and if it comes back and gets your order, cool. And if it doesn't, then you just cancel the order at the end of the day, right? Or you cancel it at a certain time of day if you're maybe 11 o'clock is your cutoff or something for this criteria. But it would be an order triggers order type setup there. So that's really cool.
2-to-1 in low of day. As we play the tape here, you can see price ends up tapping it once more, tries getting above, but that's why we have a stop at our opening range high. And you can see right there, right? It took a little bit of a while, but you can see the trade ended up working very nicely.
It's funny stuff like this is where the psychology will come in, guys. Like, obviously he's playing this in hyperspeed, right? And it's just like, oh, it came back and, the price started to basically go the wrong way, but then it reversed again and it ended up tapping the target, which is awesome. But this is one of those things that newer traders just won't be able to conceptualize until they sit through it a bunch of times, because initially you get, if you can see my cursor, you get this push like, oh, look at that, I'm making profits, and then it reverses on you, and now you're in the red, right? So if you're watching your P&L, you're starting to think, God damn it, this thing, it didn't push far enough for me to take the profit, and now it's reversing, and you're gonna want to just stop out here, right? You're gonna get nervous and go, screw it, I'm just gonna take it off. But really what you need to do is just let your stop and your target work, which is really, if you set your stop and your target where one cancels the other, you can just walk away, then you don't have to worry about any of the psychology stuff. But anyway, I just wanted to comment on that because this is something that newer traders won't usually have a pretty good handle on until, like I said, until they've seen it a lot of times and learned how to just sit with it, trust the system. If they have back tested it and even traded it in real time and it's been making them money, then you just learn how to trust your system and not futz with it in the middle.
For a second win of the week. As you can see, we're on our 4th day of the week, right? We've had 2 wins, 1 no trade, and we still have had 0 losses so far on the week. What we're going to be doing is marking out our opening candle highs as usual and our opening range candle low. So now we wait for the break. Right, you can see we ended up actually having a very nice displacement right here. You can see we ended up having displacement where it creates what's called a fair value gap, right? Strong candle closure above this level, and now we're going to be looking for a retest of this opening range candle right here. So right here, that's where we're going to be looking to buy with a stop just to break below that opening range 5-minute, and we're going to be looking to target a 2-to-1 risk reward ratio as usual. You can see right there, right, price ended up targeting a nice 2-to-1 risk reward ratio. And you also had a key levels above as well. So that's really where you want to scale your final position. So that would have been a very nice trade. As you can see, we backtested the strategy for 1 whole week. We've had 0 losses. We've had 1 no trade day, and we've had 3 wins. And each win was a 2-to-1 risk reward ratio. So if you could have executed the strategy properly, it would have netted you 6R for the week. We'll backtest a few more days.
Whoa, did you hear that, guys? He said R. 6R. Yeah, I like it. Obviously, it's like I said before, it's 1 week. It really doesn't mean that this is a long-term profitable strategy. Even my dog knows that. But yeah, that was cool. It was cool that he even mentioned R multiples. That's good.
To see if there's a potential other scenarios that set up with the opening range break and retest. So you can see this the very next day, right? It's Thursday, April the 30th. We're going to draw our opening range high, opening range low. And you can see right here, we'll play the tape. So you can see price tries closing below this area with no real strong displacement. So we have to wait for a strong candle closure underneath or above the opening range 5-minute and then look for that retest. So you can see right there, that is our first big candle towards the downside, where you can see a lot of displacement. So now what we can be looking for is that opening range break of the first 5 minutes.
Yeah, so again, this is like the 3rd time I'm saying this, but I just want a definition of what that means, right? Like, what is long enough of a candle? What does that excursion from the opening range have to be? That would be important to quantify, especially for new traders, because it would just, you'd say, okay, the candle has to close 0.5% below the low range or 0.5% above the high range, and then you can just mark your. In fact, you could mark it, right? You could mark your your ranges here, and then you could go, okay, what's a 0.5% above this line? Okay, it's up here somewhere, so it has to close above that in order to count as a retest.
A candle. And as you can see, price ended up tapping in.
One of the reasons that's important, guys, I just thought of this, is when you're back testing, if you're doing it with data, you have to quantify everything, right? You can't just look at charts and be like, oh yeah, no, that one would have worked, because you're introducing bias then, right? You're looking at a chart, unless you're doing it like he is, where he's playing it, as it happens. But if you just look back at charts, then you're seeing whether it worked or not before you decide whether you would discretionarily enter it or not. That sucks. So if you just quantify it and you just use the data, then you can set your code to just say, okay, if it does this, if X then Y, and crunch the numbers. So you need to quantify those things.
Into this level very nicely. That's where you want to look for a short setup. As always, you want to have a stop right here, and then you want to target at least a 2-to-1 risk to reward ratio. So in this case, right, a 2-to-1 risk to reward ratio, you're going to be looking for this. And you can see right there, technically you would have got stopped out right there for a loss. But as you can see, right, the opening range candle, there was a nice rejection off this opening range candle. It didn't offer you the 2-to-1. It was very close to a 2-to-1. But in this case, it didn't quite offer you that 2-to-1. Other things to note about the 2-to-1, if the price is kind of far away, in this case, you can see that price actually bounced off of pre-market lows. So that's actually where you could have taken your profits. You can take your profits at key levels and a 2-to-1 risk to reward ratio as well.
But you got to know that ahead of time, right? Because if you start taking your profits at this key level, like you just said, and then it actually gets to your 2 times profit target, you're going to be like, well, fuck, I wish I held it. And also, this starts skewing your risk reward. So this is, I would consider this like hindsight, I should have bullshit. And no, either the deal is you take profit at the pre-market low or whatever this is. I'm guessing that's pre-market, or maybe it's aftermarket from the day before or something. But whatever you call it, right? Potential area of support. Either that's the plan, is that you take it there, or it's not the plan and you don't take it there. You don't do this hindsight like, well, yeah, technically it got stopped out, but you could have taken your profit here. Well, you don't know that in real time, right? Unless it's like, yeah, my plan is if there's a level like this, that's where I take my profit. So that's kind of, I don't like that he explained it away like that.
So in this case, if you look to scale profits, you could have looked to scale at pre-market low and then leave trailers potentially for a 2-to-1 risk reward.
Okay, yeah, I get that. But again, that has to be part of your plan and part of your backtest strategy. So when you backtest this, if you backtest it on a strict 2-to-1 profit to loss ratio, then you leave that, and that's the way you trade it. Don't go fucking with your system, because if it works, right? Why would you mess with it? Why would you let your dumb brain start talking you out of a system that works? But if this is going to be your system, like, hey, maybe your system is I take half off at 1R and then I let the rest ride for 2R. That's a perfectly fine system too, like regardless of what other levels are on your chart. Like maybe you just quantify it that way, and you like taking profits a little earlier because it just makes you more comfortable. And I think there's nothing wrong with that. So anyway, let's keep going here. We're almost done.
Reward ratio. And of course, if you take a first profit target, then you can move your stops to break even. So depending on how you manage your trade, you can easily make this so it's a lot more high probability and you can win a lot more, right? You don't always have to target a 2-to-1 risk reward ratio. That's what I do personally. But if there's key levels around that 2-to-1, right, you can always scale there as well, right? It's not perfect.
So that's a good trade-off too. He's talking about like taking a profit and then moving your stop to break even, and you'll have a higher win rate that way, but you'll probably have a little bit lesser risk reward to risk ratio, right? So, which is fine. That doesn't necessarily make it wrong. It's all about, this is where it's like, what's your personality? Do you like to be really conservative and like take profits when you get them, and then move your stop to break even, protect that break even area, and not give profits back? Or do you like to just have a really simple, like, okay, stop here, target there, walk away, let it happen kind of approach? And neither one is wrong if you can make it work. If it works, it works, right? If it makes money, it makes money. That's all we really care about. So a little bit of it is just figuring out what's good for you personally.
Perfectly going to be 2-to-1 on every single trade. Some trades are going to be a little bit more than 2-to-1, and some trades are going to be a little bit less. But overall, in the general grand scheme of things, right, you want to average a 2-to-1 risk to reward ratio. If you have a 50% win rate, which this strategy does, if you execute it properly, you can become very profitable. You just have to be patient and wait for the setup to present itself. So
Okay, so he just said that this strategy has a 50% win rate, which he didn't show us with any real um, conviction, right? I mean, we need like, okay, show us your trades for the last, I don't know, year, two, 20 years. Show us a back test. And also, where did the $500 per day come in on this? I don't. Again, it's a nothing burger, but all right.
So with that being said, I hope you guys did enjoy that video. If you did, make sure to drop me a like and sub. If you guys do test out the strategy, make sure to backtest it. Let me know how it goes. Put that in the comment section below. And
Okay, should we check out the comment section? No, I'm not going to, because the comments on YouTube are whatever. Yeah, overall, guys, I go ahead, test it. I think it's probably a worth looking into. I've tested opening range breakouts in either direction with some other biases, and I've never found it to be a profitable strategy. I've tested, opening range breakout to the high side, to the upside, so going long, and only doing that when the moving averages like the 10, 20, and the 50 are stacked and rising. So you're in an uptrend, and still on different time frames, 1 minute, 5 minute, 15 minute. I just didn't find anything that was really profitable. But it's always worth not taking my word for it and putting in the work. Back testing with data will teach you so much about trading. That's why I spent a long time teaching myself Python. I had a little help from some guys I used to be in a trading room with. One guy in particular, you can look him up on X. He's Day Trading Zoo. He used to, I don't know if he posts that much about with code anymore, but he used to post a lot. And yeah, anyway, he was super helpful, and I still like the stuff that he puts out. But I taught myself Python. I got my Polygon IO subscription, and I back tested a ton of shit, and I still do. I don't do it as much as I used to, but I actually might play with this scalping thing, this opening range thing he's got here, just see what I can get out of it. But I'll make another video about that if I do. So, all right, guys, that's it. I'm done for now. So stay curious, but stay skeptical. See you guys later.